December 19, 2020. This is episode 143. Can I save on tax by buying a vacation home? This is 39.6, Facebook and YouTube Live Finance Show. The show that teaches high earners like yourselves how to make your money work for you, so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for childcare, paying for college, and even the car you drive. In today's episode, we'll discuss other potential tax savings measures you can take by spending your money. Should I buy a vacation home ultimately to save on tax? All right. So this is a complicated thing because, again, you want to save on tax, but spending money to save on tax is still spending money. So ideally, if you're spending money to save on tax, you want that spending to actually also make you money, right? Like if you're spending money for a business expense that's going to help generate more revenue, then that's fantastic. But if you're just buying something, saving on tax, and it's not generating more revenue, it's still depleting the cash in your account. Now, buying a vacation home is pretty complicated from a tax perspective. Let's just say you buy your own vacation home simply to have a second home. Like this year during COVID, it would have been fantastic to have like a lake house. Not really that kind of I need to have a lake house kind of a guy. I don't really boat. But having a place, out in the woods where you can have a campfire and have some water and whatnot, and get away on the weekends, especially in the COVID year we had, it would have been amazing. And we did go to Broken Bow for a handful of days over Labor Day, and it's crazy expensive. We spent, like $700 a night for a cabin, something a lot more than I would have historically spent. Like we went to Paris for like $5,000 between my wife and I for a whole week. So there's definitely benefits of having a vacation home. Now, if I just bought a vacation home and let's pretend I didn't have any mortgage interest or on my first home, like let's say my first home, I already have that paid off in cash. And let's pretend there's not much property tax on that first home. Well, yeah, the second home actually can potentially help us in saving tax because a second home that is for personal use, you can count that mortgage interest and property tax as itemized deductions on your Schedule A, the same way you can on your primary residence. However, if you are paying, let's say, $10,000 a year already in property tax on your first home, the second home, that property tax is still going to be above that $10,000 limit. You're not going to be able to deduct more than $10,000 of property tax. Sorry, I still have a sticker from yesterday that my toddler put on my hand. I can't get rid of it. Haven't been able to get rid of it. So that property tax is basically already going to be non-deductible, assuming you've already hit the $10,000 threshold in property tax or state income tax if you live in a state with income tax. Now, the mortgage interest, sure, could be deductible, but this is still also capped on how much principal you have in your mortgages. So it used to be $1 million of a mortgage. All that mortgage interest is deductible. And we got in under that window because that's what it was years ago. But then with the Tax Cuts and Jobs Act, they changed a lot of things. A lot of things got cheaper tax-wise. However, there were certain things that got more expensive tax-wise. And one of those things was the mortgage interest principal amount. So it went down from $1 million to $750,000. So let's pretend you bought your house 2 years ago and you're at $750,000 plus on your principal. And so you've already filled up that whole $750,000 of principal that has interest that's tax deductible. On your second house, that mortgage interest is not going to be tax deductible. So you would potentially be buying the second house, paying property tax and interest, and have no tax deduction on it at all. So a lot of it is dependent on what the situation is with your first house, how much mortgage principal you have left on it, as well as how much SALT tax you're already paying. SALT being state and local income tax. Are you already paying before you buy that house? Because remember, it's capped at $10,000. Now, again, all of these rules can be changed, right? We don't really know what future tax laws are going to be, but based on current tax laws, that's one thing you have to definitely consider. Now, remember, we have this Airbnb loophole on Schedule C, which is huge. If you were to buy a vacation house, one of the best things you could do is buy it like today, December 19th, get it furnished tomorrow, and get it listed on Airbnb tomorrow, and then get like 2 guests in that each book it for like 2 days between now and the new year. Then you would have 100% business use. It would be rented out an average of less than 7 days. And you would then be able to take bonus depreciation on the house. All that bonus depreciation will be written off in first year, in year 2020. Okay. And you'll take that on Schedule C as this gigantic loss. Let's pretend you buy yourself like a $300,000 vacation home. And let's pretend the land value is $100,000, and let's pretend the house value is $200,000. Then about 25% of that house value, let's say $50,000, approximately, would be able to be written off in that first year. So that'd be a $50,000 tax deduction, and that would save you at the top tax bracket almost $20,000. Federal, if you're at the top tax bracket, and if you're, let's say, paying state tax, it could be over $20,000. Okay, so that's one nice thing you can do. Now it's furnished and it's been rented out. And then in 2021, let's pretend you don't want to have renters anymore. That's fine. You just want to be for yourself. Fine. You've already depreciated the asset in 2020, and in 2021 going forward, you just use it as your own personal secondary home, and that's fine. You just have to remember that when you sell the asset, if you do, you're going to have to do recapture some of what you depreciated. Okay. However, let's pretend this vacation home, you're buying it as your retirement home. Okay, so then you don't actually have to worry about recapture, because this is a property that you're going to take with you to the grave, basically. And so then you'll pass it down to, let's say, your kids in a trust, and they're going to get a step up in basis. And when you do that, I think all that depreciation, then basically all this disappears. So you could buy the property now, make it a vacation rental now, 100% business use this calendar year, Schedule C, get at least 1 booking under 7 days. And then once you have that booked, take your bonus depreciation for 2020, just convert it to personal use for 2021, hold on to it. And then when you retire, you move into that, and you don't have to worry about the depreciation you took. Now, you could continue keeping it as a vacation rental, until then, and have it professionally managed. The first year you want to manage it yourself, so you can take that Schedule C, and then after that you can have it professionally managed, and it won't matter as much. It could be on Schedule E, but you've already depreciated so much of it that it's not that big of a deal. And you could have it as a vacation rental for X number of weeks per year, and block it out for yourself, for your family, for other weeks. However, and maybe cash flow even, save some on tax. You can write off all your drives to the property, because you can make those business drives. And hinting back to few episodes ago when we talked about getting a car for business use. This is actually one of the key ways to keep your car more than 50% business use. So you have some sort of business activity that's far away, and you use that vehicle for those drives, right? So let's pretend during the week, Monday through Friday, you're driving locally and you're putting on like 10 miles a day, but you're using it all the time, but it's mostly personal use. Let's just say, for example, however, every other weekend, you drive it to your vacation rental and you're just there for 2 days and you do some business use on each day that you're there, whatever it is, coordinate contractors or whatever. You get to count all of those miles for business use each way. And when you look at 50% business use, you want more than 50% of your miles to be business use. So if your vacation house is 200 miles away and you get 400 miles round trip, there you go. That's 400 miles round trip, and that gives you 399 personal miles you can use and still stay over the 50% threshold of keeping that car for business use. So just a little thing you can do there. So you could have the car, for example, titled to like one of your entities that's like we have one that's like our property management entity. Okay, so we could do it that way, and that would allow us. This is actually pretty good stuff. I should think about doing this myself. Buy myself a vacation rental 4 hours away. Buy myself a 6,000. Buy myself a Tesla X. Write it all off in this year, and then drive the Tesla X. As long as you have enough battery on the Tesla X to get to, and ideally back to and from the cabin. There you go. This is really good. So there you go. That's like an ideal way to do this. Now, if you don't want to make it a rental property all the time, that's fine. Just use it for personal use after the first year when you depreciate it. That's fine. But remember, you still have the 14-day rule, the master's clause. Like you can rent it out for 14 days per year, and you can't write off expenses, but you don't have to claim the income. So it is something you could do. Like, let's say you don't want to rent it out all year round, but let's pretend you do want to rent it out. You're willing to rent it out Memorial Weekend and Labor Day for like a week at a time, 7 days for Memorial, 7 days for Labor Day, because those are gigantic, booking weeks. And you could do so well on those 2 weeks that it could, pay off, let's say, I don't know, 8 months of your mortgage payment. And then you still have the place to yourself for the whole rest of the summer. Something like that. Those 14 days would be completely tax-free. You wouldn't have any depreciation. You wouldn't have any other expenses to write off. But if you don't want to have it, as like a full-time vacation rental, and really want it to be primarily your own home, you can just do those 14 days and crank up the rates, put it on the peak weeks, and charge a ton. And what happens is the nicest places, even if they cost a good amount, especially these key weeks, a lot of times they're booked a year in advance. And so people who are paying that much, what we've found in years of doing this is that the people who are willing to pay the most are the people you have the least issues with. They take the best care of your home. They're the most reasonable people in general, but they have homes too. Anyway, it is something that definitely is reasonably worthwhile. And it's a vacation home, right? It's not like it's your own personal home. It's not like you have a whole bunch of your own stuff there anyway. It shouldn't be a big deal. And you can still have it professionally managed just for those 2 weeks. It's just that you are not able to deduct the cost of management when you use that 14-day rule. Anything else above 14 days, you're talking about doing this as a regular rental property, a vacation rental. There's some different rules depending on what proportion is business use versus personal use. But once you get over that 14-day rule. All right. But that's about it. Go buy yourself a vacation house today. You have like 12 days to get this done for this year. Anything in the chat? Thank you for doing this. You are very very welcome for doing this, Facebook user. It's good to see people here on a Saturday. Say Saturday? Saturday night. Yeah, it's like the first day of vacation. It's like every day's Saturday right now. Had an awesome day, just spending like the entire day with the kids, including nap time. It's like the best thing ever. And now the kids, well, one's asleep, the other's going to sleep. So until tomorrow, episode 144, happy holidays. And I have a stack of extra Christmas cards. I need to put in a form. So if you guys want to get a Christmas card, we ordered like, I think we have like maybe 30 extra or so. We ordered like 450 Christmas cards. I think every year it goes up more and more. I can't keep track. Okay. Have a good night. Again, my entertainment, yours maybe, not legal, not professional, not tax, any other advice. Talk to your professionals before making any financial decisions. Take care.